Hello and welcome to myfinancesteacher.org. Let's have a quick update about the general stock market. Amid a lot of worry right here, we see huge red candles on S&P 500 and on some of other stock indices. But if you zoom out a little bit, you will realize that from the very peak on the 22nd of November, the general stock market so far has lost under 5%. So is the stock market ready to fall out of bed over here to continue down for another 20% or more? Or are the worries exaggerated? Is there a buying opportunity brewing up sometime soon? Well, let's have a look at our usual factors, starting with the cycles. The general stock markets follow intermediate as well as short-term daily cycles. Since the pandemic fall, we've seen 3 intermediate cycles completed. Usually these intermediate cycles last for around half a year, somewhere over half a year on the general stock market. The previous intermediate cycle was quite long at 214 days. Usually within these intermediate cycles we see short-term daily cycles lasting for over 2 months in the general stock market, somewhere around 71 days or so since the pandemic low in March 2020. We're now 58 days into the ongoing short-term daily cycle as well as the intermediate cycle, as we have started the new intermediate cycle on the 4th of October. So I think we are getting very close to the short-term daily cycle low. And if that low actually happened yesterday on the 1st of December, then this black line that we drew quite a while ago will turn out to be quite predictive in what the market was expected to do, at least in terms of timing, if not in terms of the actual levels. Given the severity of the drop, perhaps we have observed the short-term daily cycle low yesterday. Although usually, as I mentioned, these cycles last for just over a couple of months. So based on the cycles, I am getting quite positive on the general stock market. After reducing my allocation near the top sometime in November, I'm now accumulating into larger positions starting yesterday morning after a few days of a decline into the short-term daily cycle. Unfortunately, yesterday's morning reaccumulation was just a couple of hours before this dramatic drop based on somewhat of a hawkish statement from the Fed. Looks like the Fed doesn't see inflation as transitory anymore, but of course we knew about that for quite a while already, and the Fed is even hinting at speeding up the tapering process, so removing this excess liquidity a little bit faster from the stock markets. With these comments, of course, a drop in the general stock market is understandable. Although based on the cycles, I expect a cycle low very soon, either yesterday or over the next several days. Based on the support zones, it's unfortunate that the S&P 500 dropped below the 50-day moving average. That's not really a great sign. However, there are multiple support zones all converging just under the current levels based on this late September high. That's somewhere around 4470 on S&P 500. Based on this early October high, that's somewhere around 4430 on S&P 500. And based on the Fibonacci retracement of all of this ongoing new short-term daily cycle. The close on S&P 500 yesterday retraced 50%, which is one of the most common retracement levels. As I mentioned many times in my videos, 3 of the most common retracement levels are either 38%, 50% or 62% Fibonacci retracement. So even if the stock markets continue down for another, say, several days, there is a strong confluence of support zones based on the 62% Fibonacci retracement and on the previous highs just below the current levels on S&P 500. So you would strongly expect at least a tradable bounce out of that convergence of support zones. Talking about the intermediate cycle, it's still very young at 58 days old, so it's highly unlikely that the intermediate cycle has already topped on the 22nd of November, only 49 days into the ongoing intermediate cycle. So I still expect higher highs within the intermediate term, perhaps over the next several weeks, over the next couple of months. And one of the potential drivers for that could be some sort of a Christmas rally. Next, looking at some other indices, we see that nasdaq is relatively better than S&P 500. It's still above its 50-day moving average, and so is the semiconductor index, which hasn't even dropped below its recent low on the 26th of November. So even though the health-related fears are also weighing the markets down a little bit, these fears are not as pronounced in tech-related industries. Next, let's have a look at a few very important indicators of the general mood, of the general sentiment on the markets, starting with this optimism index. But before that, allow me a quick plug-in. Let me first welcome you at myfinancesteacher.org, which is a community of like-minded investors where I make regular updates on a range of markets, including precious metals, cryptocurrencies, stock market indices, energy, including uranium and fossil energy, as well as commodities such as copper, grains, and others. One of the interesting products in the community is the model portfolio, which is transparent, showing all of the history of my trades with the total gains without any leverage. So that's without taking too much risk, is around 55% between July 2020 and October 2021. With a 2x leverage, one perhaps could double the portfolio size in the same period. So if you want to see what's going on in the investment community, you are more than welcome to register. With the recent decline in S&P 500, the optimism index has dropped quite a lot to levels that are usually comparable to intermediate cycle lows. So the market is quite worried right here, and we're around the area where this proverbial blood is on the streets. And as they say, you generally want to buy assets when this proverbial blood is on the streets. We see that previous intermediate cycle lows all through 2019, for example, in 2020 and in 2021, came with this optimism index coming close to the green line, somewhere around 30 or even around 40, as in 2019. So based on this historical observation, the current levels of the optimism index at 35 is likely to be a pretty good buying opportunity. Of course, there are times when the markets can just drop out of bed completely, bringing the sentiment even further down into extremely bloody levels, as during the pandemic crash in March 2020. But these usually happen once in a while. Usually we observe what's known as 4-year cycles in the general stock market. So we wouldn't expect an extreme drop down to bear market territory anytime soon. Next, let's have a look at a similar indicator, Fear and Greed Index by CNN. We see that the markets are already very, very fearful. This proverbial blood again is on the street. The Fear and Greed Index is at 22. And again, looking at history through 2019, 2020, and 2021, usually the markets show us some sort of an intermediate cycle low somewhere around the level of 20, and sometimes even somewhere around the level of 30 on this Fear and Greed Index. So the current level of 22 is already a pretty good indicator that you might consider increasing your allocation to the general stock market. And lastly, let's have a look at confidence levels of both smart and dumb money traders. As I mentioned many times in my videos, the smart money traders are usually the institutional traders, reported as commercials on the COT reports, and dumb money traders are usually smaller speculators, reported as the speculators on the COT reports. The red line over here is the dumb money confidence, the blue line is the smart money confidence. Looking at the blue line, we see that usually the smart money confidence peaks at some sort of intermediate cycle lows. For example, this prominent peak in the smart money confidence at the low of the pandemic crash, and relatively significant peaks in this smart money confidence in mid-2019 at the intermediate cycle low, and in late 2019 at another intermediate cycle low. And many other peaks, perhaps not as prominent, in the second half of 2020 at that intermediate cycle low, and in the first half of 2019 at another modest intermediate cycle low. The most recent intermediate cycle low a couple of months ago also came with a relatively prominent peak in this smart money confidence. The red line, as you see, the dumb money confidence, generally moves opposite to that of the blue line, So simply the opposite argument stands here. And lastly, looking at the futures for S&P 500, we see that the futures are already over 0.5% up, so perhaps a rebound in the general stock markets is about to start already, if not in the next several days. So that's my outlook for the general stock market. Next, it's your turn. Let me know what you think in the comments below. Are we starting a bear market crash from these dizzyingly high overvalued stock market levels? And before you type in those comments, remember to hit the like button. I would really appreciate that. Subscribe to the channel and share this video with your friends. I wish you a pleasant day and good luck in your trades.